Welcome everyone to this month's webinar. My name is Puri and I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. And today I'm honored to be sharing the stage with John Mark Young, the President and Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Needless to say, this is going to be a data-filled, fairly, nerdy, as Michael Kitces would say, discussion. So in today's discussion, we'll have John Mark kick us off with a high-level holistic review of key market activities and headlines. And today we'll spend time reviewing the macroeconomic data, and finally we'll do a deep dive on the equity side and bond side of the markets to understand what the true impact was to your whole portfolio. So with that being said, I'm going to hand it over to our fearless leader, John Mark, to paint the picture of the market key activities and the main headlines from the past year, or from this quarter, or excuse me, from year to date.
Yeah, thanks so much, Summit. And if you're watching this video today, whether it's the YouTube replay or you're here live with us, you are one of the few, the proud, the brave, because when we do a webinar on taxes, we'll get hundreds of people that'll come. When we do a webinar on the markets, not so many people want to come and listen to that, but you do, and that's great. And hopefully we're going to have some great data to load you up with today there. Now, when you think about this year, Summit, the stock market, every single year in the stock market can almost be like a fingerprint. They're all very unique. Sometimes they rhyme, but they're all very unique. And if 2025 wasn't a very unique stock market thus far, we're halfway through it as of today. The market is now closed, so it's official, Summit. We are at the halfway point, and we're ready to see what the second half brings. But if you think back to the first half of this year, it was filled with a lot of pessimism. And that's kind of normal, unfortunately. I mean, there were recession forecasts as soon as a tariff tantrum hit on every front page of every major publication, whether it be a financial publication or just a normal New York Times type of publication. There was, of course, a resurgence of inflation panic from tariffs because many assumed that the Fed was just going to be forced to keep rates higher throughout the remainder of 2025 because of the tariffs. We're going to talk about that in a little bit. And then valuation warnings were being repeated by almost every strategist that, tariffs were going to cause valuation misses, earnings misses, and that was going to be problematic for the stock market. And yet, the same story played itself out, grounded in discipline, being diversified, and having faith in human progress proved to be the right answer once again. Now let me give you a quick few examples of how extreme the negativity became, because our friend Tom Lee, the gentleman that leads our outsourced research department, he says this is the most hated rally, the most hated rally of the stock market he's ever seen. Now, why would that be the case? Well, think about this. There's something called the Bank of America Global Fund Manager Survey, Summit, and this is a survey of mutual fund managers and ETF managers, the people that essentially are responsible for picking stocks within mutual funds. So this is one of the largest institutional sentiment polls that the world has today. And the early surveys this year showed the highest percentage ever recorded. I'm not talking about in a few years. This is the highest percentage ever recorded of fund managers planning to reduce their exposure to the U.S. stock market. To put that in perspective, more managers said that they would sell U.S. stocks than at any point during the global financial crisis, 2008, which was, of course, the worst stock market of most of our lives, or even the COVID crash, which was the fastest and deepest stock market of most of our lives there. How about this? Goldman Sachs has this thing called their prime brokerage, and it's basically what the hedge funds are doing. They can kind of give us some insight into that. Well, hedge funds built the largest notional gross short position, meaning they were putting money on the stock market going negative, the biggest in history. So hedge funds had actually put their money where their mouth is and build up the largest short position in history earlier this year. So this was not just them betting a sector is going to be bearish. They were broad-based with their bearishness across large caps, small caps, and even some of these magnificent seven technology stocks that have done so well. And all that to say that this could be part of the reason, Summit, why hedge funds are having one of their worst years ever, because they bet on the market crashing and it hasn't been right. And then, of course, major firms downgraded U.S. equities, such as Morgan Stanley did a downgrade on U.S. equities to underweight in February. HSBC, the world's largest bank, cut their outlook, forecasting a U.S. market correction, a 20% decline. And UBS, Switzerland's largest bank, issued multiple warnings that U.S. valuations were unsustainable. And while Wall Street firms and hedge funds were consumed by fear and the desire to try to time the market, Whitaker-Myers Wealth Managers stayed focused on fundamentals, diversification, and patience. As we often remind ourselves, a great verse is Micah 6:8, which says, "He has shown you, a man, what is good, and what does the Lord require of you, but to act justly, love mercy, and to walk humbly with your God." Act justly, love mercy, and walk humbly. So the side of me that is very carnal and sin wants to say, Summit, I don't want to be humble about that, but I should because that's what we're called to do there. But this verse just, encompasses in dealing with these Wall Street projections and the temptation to get swept away by headlines. But we act justly by investing responsibly. We love mercy by guiding you through fear without judging you for that fear. A lot of the content we created on April 9th and April 8th and the 10th was all around normalizing your fear, but not having you act upon your fear. And then, of course, we try to walk humbly by recognizing that no one can perfectly predict the future, but it typically pays to be optimistic. And that's what we were optimistic. So Summit, with that, let's start digging into some of the data that we've seen throughout the first half of 2025.
Yeah, sounds good. Now, John Mark highlighted a lot of key factors there, but at Whitaker-Myers, one of our core principles is to remain diversified. And so we do look at a lot of macroeconomic data, and certainly we look at what's happening in the market to identify where we can go, what opportunities lie. But as we continue to remain diversified, that is really the best way and the best strategy that we continue to provide value for you all. So one of the key metrics that we always like to focus on is what's happening in the market from a macro environment that we always look at is unemployment. And so we look at this in two lenses. So what you can see on the top of your screen here is the initial claims for unemployment insurance, which actually shows how many people are applying for unemployment. And the bottom graph here is showing you continuing claims for unemployment insurance. Now, what you're seeing, this is a year-to-date data set that's shown the trends of what's happening in the market. And specifically with initial claims, we saw a peak reaching nearly 250,000, but we've seen that come back down to 236,000 over the last week or so, 2 weeks. However, what we're seeing on this other end is continuing claims has continued to rise since around end of April, early May. And so this is actually identifying some key components and some things that I think we want to highlight. John Mark, I know you wanted to talk a little bit about this. Did you want to take a couple minutes and talk to the rest of our viewers about this data?
Yeah, we think initial claims for unemployment is such a positive leading thing to look at when you're trying to get a feel for what might happen in the future economically with the U.S. economy. Of course, initial unemployment claims, these represent the number of individuals that are filing for unemployment insurance for the first time in a given week. And so in another way, you could describe them as emerging layoffs. These are people that are, just been laid off. There. And what's wonderful about this data summit is every Thursday, you and I get a chance to turn on CNBC, Fox Business, and every Thursday we get this data. So it is fresh, it is real time, and it is a great insight. Now, why is it such a great insight? Well, again, we would consider it a leading indicator, not just we, the general consensus of the economic world would consider it a leading indicator there. And it's a leading indicator for perhaps what might be the most important thing about our economy. And the most important thing about our economy is jobs. there's a basic formula that we could create to keep this a lot more simpler. And that formula is jobs equal income, income equals spending. Jobs equal income, and income equals spending. And spending is three-fourths of the economy, as we know. So it's a lot. It's a big component of the economy. It begs the question is, can there even be a recession if the job market is as strong as the job market is there? We get a JOLTS report. A JOLTS report is a report from the Federal Reserve, and it's a report on the job market. And currently, right now, there's close to 7 million open jobs out there available. Now, is that number overinflated? Maybe, perhaps, but that's still a historically high number of open jobs. And again, that begs the question, Summit, is can the economy even get really bad if the job market's plentiful? Because if you have a job, you're going to have income. And if you have income, you're going to be spending. When people are earning a paycheck, even if it's a modest paycheck, they continue to spend on essentials, on travel, on entertainment, on debt repayment. And that income flow fuels demand and keeps businesses hiring. And it kind of creates a self-reinforcing cycle that happens there. Now, we talk a lot about sentiment headlines, and these are just surveys where you ask people, are you pessimistic or are you optimistic? And a lot of those sentiment surveys have been pretty negative this year, but sentiment isn't the same thing as behavior. Oftentimes, people will say they feel negative, but they're still booking vacations, they're still buying cars, and they're still going out to eat. There. And so in a lot of ways, the labor market is the economy's shock absorber. A tight labor market like today's that we're in currently gives people confidence. They feel secure. They're less afraid to spend. And even modest wage growth helps people keep up with inflation, service their debts. And the nice thing about debts, of course, we don't advocate for debt, but debts really never get inflated, meaning you buy your mortgage 20 years ago, guess what your payment is today? Pretty much the same payment you were paying 20 years ago. Of course, the insurance and the taxes get inflated there. But ultimately, again, even just modest wage growth help people keep up and keep pace with things. And data confirms this dynamic. Historically, recessions don't begin until initial jobless claims spike and unemployment rises pretty sharply. And as of now, job openings still outpace the number of unemployed Americans, and wage growth remains solid. The number you really want to pay attention to on this chart is that 250,000, which we highlighted as the high because it was the high. But when these numbers start to stay above 250,000, that's where there could be a problem within the labor market. Now, of course, as you can see on the bottom number, the continuing claims, the people that are on unemployment and staying on unemployment, meaning they're not going and getting a job, that number has spiked up recently, and it's close to about 2 million today. That number is one we're watching. But as of right now, the initial claims number is still within a historically good number. And so we would say there's reasons to be optimistic about the U.S. economy and thus optimistic about the U.S. stock market when that number is pretty low.
Now, on that same note, as we look at unemployment, we look at initial claims, and we certainly look at those that are staying on unemployment, but we also look at an overall unemployment rate. And so what you're seeing here is the labor market, the May unemployment rate remains steady at around 4.2%. And that's what we're seeing here. It's been around 4.2%, or 4 to 4.2%. And that, just for context, is still historically pretty low. And this is within a normal rate that we would like to see it at. So this is something I think we want to highlight. This is not something to be very concerned about. Tracking around 4 to 4.2% is actually in a good place. What I've highlighted down here is the labor force participation rate. Now this graph down here is looking from July 22nd to more recently. This is showing that those that are willing and able to participate in the U.S. labor market, we've seen a little bit of a dip. But if we take a look at the difference, we're looking at 62.4% versus 62.8%. So reality, over the last 3 to 5 years, it hasn't seen that much of a difference. But the participation, once again, is something that we are certainly tracking. And as John Mark mentioned earlier, that there certainly there is a relationship that we need to continue to track, and we are tracking, between unemployment, inflation, job growth, and the overall economy. John Mark, do you have any thoughts on that you'd like to share with the viewers?
Yeah, well, of course, when you think about unemployment and you think about inflation, those are the Fed's two mandates to high un, maintain a robust labor market, don't let unemployment get too high, and keep inflation in the preferred margin, which of course we know is around 2% that they want to see. The problem with that, Summit, is it's basically like me giving you a job, and those two jobs are kind of they work opposite of each other. Because unemployment and inflation often move in opposite directions, meaning when unemployment is low, more people are working, more people are earning, and that, as we talked about, that boosts spending and that boosts demand for goods and services. And that demand, if it's too extreme, can push prices up, leading to higher inflation. There, when unemployment rises, when more people are unemployed, people spend less, businesses pull back, and inflation often cools down there. And a more recent example of this, it'd be a little bit outside of the peripheral of the numbers we looked at here, but in 2021 and 2022, when unemployment fell rapidly after COVID, inflation spiked to 40-year highs because demand was just overwhelming supply there. So you've got those two competing interests, and the Fed funds rate, the rate that the Federal Reserve controls, is the lever to try to balance those two competing interests. So the Fed funds rate is the short-term interest rate. That's what the Fed controls. They really can't control long-term interest rates. That's going to be controlled more by the market. But the Federal Reserve sets influence on borrowing costs based on that Fed funds rate, that shorter-term interest rate. So when inflation is too high, the Fed raises rates to make borrowing more expensive. This slows consumer spending and business investment, which can cool inflation, but it's going to risk higher unemployment. And so think about what happened in 2022. January, February, March, we started to have inflation that was creeping up to 9%. So everybody was happy to buy their I bonds at that point in time because we were getting 9% on an I bond. But we don't want that kind of inflation, albeit it helped I bonds. And so the Fed, trying to cool inflation, what'd they do? They raised interest rates from 0 to 5% really quick. And the risk of that was potentially they were going to slow down the economy so much that they were risking higher unemployment. So when growth slows or unemployment rises, the Federal Reserve then lowers rates to make credit cheaper, to make borrowing costs cheaper, that's short end, and stimulate in spending and stimulate investment there. So you can almost, if you're trying to think of this very simplistically, think about it as a thermostat. If it's too hot, the Fed turns the dial up, higher rates. If it's too cold, they turn it down, they lower rates there. And that's kind of how all that works together.
Most certainly. So measuring inflation is very important. And we spent a lot of time talking about inflation. Now, inflation certainly impacts our ability to afford groceries and our daily living needs. So there is a direct correlation between inflation and sentiment that I always like to look at from a visual perspective. I'm a visual learner, so let's take a look at that. John Mark kind of hit on inflation and sentiment in the previous conversation, but you can very quickly see this, that as consumer sentiment comes down, and by the way, let me take a quick step back. The U.S. Consumer Sentiment Index, which is reported and aggregated by the University of Michigan, what it does is it surveys households on personal finances, business conditions, and buying conditions for their major items. And so by taking and aggregating this information, we get an idea of what and how households are feeling around their sentiment and certainly the economy as a whole. But as you can see here, looking at this information together, you can quickly see how as inflation goes up, sentiment comes down. Once again, your buying power goes down during these times. So very interesting to see. I always find visuals when it comes to this information to really present exactly what I'm looking for and really makes it easier for me to understand. Now, when I'm talking about inflation, when we're talking about sentiment, one of the other key indicators that we look at is the volatility index. Now, another measure of investor sentiment, as I mentioned, is the VIX. The CBOE volatility index, which is also often called the fear index, is a real-time market index that represents the market expectations for the relative strength of near-term price changes of the S&P 500. Now, it's derived from prices of the SPX or the S&P 500, but specifically looking at index options that are purchased for near-term expectations. And so this is generating a 30-day forward projection on volatility. Now, generally, the VIX rises when stocks fall and declines when stocks rise. And this is what I talk about on weekly, that you see this often where you see a inverse price to action relationship. And so once again, I love seeing this in an image, and it's very easy to predict that here or see that here. But you can see as the VIX rose, you can very see how quickly the S&P 500 dropped. We can see that also in near volatility, where we saw in April, as the VIX rose, we also saw the S&P 500 drop. Now, it's very important. We've talked about inflation. We've talked about sentiment. We've talked about short-term rates and borrowing. We've even talked about unemployment. But there's one piece of this puzzle that I think that is very important to our listeners that we really need to focus on, John Mark, and that is affordability. Our biggest expense that most of us have is our home. So let's talk a little bit about mortgage rates and affordability. So what we've seen here is over the last year or so, and I pulled this for the last 12 months, the 30-year mortgage rates have remained around, or actually ended at 6.77%, with a peak during this time frame of 7.04%. You can see that on the graph there. The 15-year, and I apologize, probably should have explained this. The top graph here is showing the trend of the 15-year and the 30-year mortgage rates. As I mentioned, 7.04% as a high for the 30-year, and ending at 6.77%, which is for the latest reading. 5.89% for the 15-year, and the high that we've seen during this last 12 months, is a high of 6.27%. What I've added here to really highlight the conversation around affordability is what are existing home median sale prices and what are sale prices for new houses that are sold during the same time period. What I thought was really interesting during this time is there was a time that you could buy an older house or an existing home for more expensive than a new home during the same 12 months. So the market's definitely changed. We're watching all of this information, and certainly it's coming to light. Since affordability is still a challenge, and we're seeing home prices, as you're saying, at $422,000 for existing homes, $426,000 for new homes, still being a challenge right now. Interest rates, inflation, and home prices are all major factors that come into and define how affordability is, and how we define what affordability is. So as we continue, and excuse me, we will continue to track this information very, very closely. Now, we spent a lot of time digging into these details, but John Mark, how about we take a little bit of a step back and talk about the U.S. GDP, specifically, obviously, as we define it as gross domestic product.
Yeah, so U.S. GDP to start the year for the first quarter actually was negative for the first 3 months of the year. Now, that was before the tariffs came about. Of course, we know that Liberation Day was right at the beginning of April. That was the start of the second quarter. But certainly companies knew it was coming, and that could have been part of the reason why we saw a major change in that GDP number as people stocked up their inventories pretty significantly in that first quarter. But while we don't know quite what the second quarter's GDP was, because it just is getting ready to end as we speak, we do get a peripheral that's somewhat fairly accurate from the Atlanta Federal Reserve. And that Atlanta Fed report is what you're seeing on your screen here. Now, there was a point in this quarter that the Atlanta Fed was predicting close to about a 4%, over actually a 4% GDP number for the second quarter. That number has come down quite significantly. It's in the high twos at this point. Still a fairly good number, but obviously with a negative first quarter, you would hope and expect that the second quarter is going to be a little bit better. Now, obviously, we're getting ready to hopefully pass a tax bill here, and that tax bill is predicated on a much higher growth of the economy which is going to be the pay for the tax cuts that we're all going to be receiving in 2025 and over the next, hopefully 5-10 years, thanks to this tax bill. The CBD, the Congressional Budget Office, the CBO, they are predicting a 1.8% growth rate. That's the way that Congress mandates they run those numbers, where the Trump administration and Republican House and Senate are making the arguments that the pay for this is stronger economic growth, that we'll see, and we did after the 2017 Jobs and Tax Act, a higher growth rate in our national growth, our national GDP, and that will manifest itself in more tax receipts received by the government. So that's why this number is very important, because when we get this tax bill, and we would say the tax bill needs to be paid for, the pay for the tax bill is what you're looking at on your screen right now, GDP, growth. We need the growth to bring in the tax dollars to pay for the tax bill there. And so it's very encouraging to see a better number in quarter two, 2025. And again, we'll get the official number into the third quarter. And then the question will be, what does Q3, Q4 look like? We have some thoughts on that we'll talk about later, but that's kind of where we're at right now from a GDP, from the growth of the U.S. economy perspective right now.
Great. Thank you, John Mark. We've spent a lot of time looking at various macro indicators, excuse me, and we've looked at all different aspects of it. So let's take a couple minutes and hop into some market data and show our viewers what has happened so far. So despite a challenging start to the year, the stock market has certainly reached new record levels. The S&P 500, and this is data as of Friday of last week. So I haven't incorporated today's data yet, but as of last week, the S&P 500 and the Nasdaq recently surpassed their previous peaks, with year-to-date returns greater than 5% each. The Dow Jones Industrial Average is only 2.6% below its all-time high. And this is the result of many parts of the market rebounding. So we saw this across various different styles, sectors, and asset classes. So while there's still
right on that summit.
I'm sorry?
Is that?
Oh, I'm getting to that just really quickly. While there's still market challenges ahead, this is a reminder that it has been more important to stick to long-term plans than react to every headline. So let's talk about that in more detail. So what we're seeing here, everyone, is the data showing for Q2 specifically. So these are Q2 returns. Now, as we look at these indicators and these indices on your screen, remember we categorize them in 4 different categories that we always look at. So growth and income, which is aggregated in the S&P 500. The Russell 2000 represents aggressive growth for us, and certainly the MSCI EAFE, as we're looking at total returns, is looking at the international category. Now, in Q2, certainly seeing the volatility that we saw early in the quarter, we've seen all of that rebound, as I mentioned earlier, with the MSCI EAFE or international returning nearly almost 11%, the S&P 500 returning nearly 10%, and the aggressive growth stocks returning over 8.3%. What I think is interesting when we look at this, we can certainly look at it over a small time period, but it's always better to look at it over a longer time period. So let's gradually increase that time period. Year to date, what we're seeing is international continues to shine and outperform. We've seen this divergence from the beginning of the year, where international stocks have continued to do really, really well as what we're seeing. Obviously, the S&P 500 is also reporting really well, greater than 5%, as I mentioned earlier. The Russell 2000 are aggressive stocks, which tend to be the most volatile of these categories here, have a little bit to grow for this year. They're down about 2%, but there's still opportunity to look at that. And I think, John Mark, as we look at these indices, it's greater and more impactful for all of us when we start looking at them at a longer time series, and that gives us better visibility on diversification. Do you mind sharing your thoughts around diversification with our viewers?
Yeah, absolutely. When you could just take the last 2 years summit as a perfect example of the benefits of diversification. And oh, by the way, sometimes you can go 5 or 10 years and diversification doesn't matter too much. But eventually it will matter. And in 2024, what do we see when we break out the Dave categories? That growth and income category in 2024 was the best category, the S&P 500 as we define it. There, it was up in the 20s. The aggressive growth, that those small to mid-sized companies in 2024 only up about 8%, and the international stock market's up about 3%. So a short-term investor would say, well, why have any other exposure? I'm just going to put it in the S&P 500 Summit. I'm just getting growth and income exposure. And the problem with that is the government makes us say past performance is not indicative of future returns for that very fact that you can't make the argument that, well, the S&P has dominated in 2024 or it's dominated over the last 10 years there, because that's not always true. I'm on a committee with Dave Ramsey, our good friend, who's and of course he's talking to 10 million plus people a week. And what he asked us to do in one of our meetings with him was help me understand from all the people that call the show and then the people that you never see on the show, but are still calling Ramsey and asking, why should I have that international exposure? Because from basically 2012 to 2025, that's been the worst performing category. It's not really benefited my portfolio. Well, of course, one thing we'd say is if you knew that back in 2012, we have a job offer for you. You can join Summit Nice team and you can help us make investment predictions because we would gladly value your crystal ball that you had there. But you don't know that. You can't know that. And the only person that we thought did know that turned out to be the largest Ponzi scheme ever, Bernie Madoff. So you should not make the assumption that was the best performer over the last 5 years or 10 years or even last year is going to be the best performer going forward. And that's why Dave says, be very disciplined, growth and income, aggressive growth and international. And this year's summit has played out to a T why that is important, because this year, the number one performer was the worst performer in 2024. It's the international stock markets. And is that going to continue to play itself out for the rest of 2025? We will see. But they've got a great head start. And had you missed that part of the portfolio, well, you've missed part of the return of this year for 2025. And that is, of course, to your detriment. And so as we tend to remind clients, everything should blend itself out over time, which is to say the thing that you're unhappy that you're invested in today is the thing that you will be happy with in the future. And that'll all wash itself out. A great way to think about diversification is if everything's working the same way at the same time, you probably are not diversified. With a truly diversified investment portfolio, some things shouldn't be working when other things are. In many years, most things are probably working, but that diversification is what you're striving for. And that's, again, of course, what we've seen over the last year. It's very powerful to see that international market come back, because when I started my career back in 2007 Summit, you know what everybody was asking? Everybody was asking, why do I have the S&P 500? Now, why would they have said that back in 2007? They would have said that back in 2007 because you know what the S&P 500 had done over that decade? A big fat nothing burger, not a lot. And so essentially where you're getting all your returns back then, international stocks, small company stocks. Now, the problem is many investors have too much recency bias. Many investors weren't around in the 2000 decade there. And so they don't remember that. And thus they think, well, the growth and income is all I should have because that's all that's working. And again, that's true. That's all that's been working, or I shouldn't say all, but it's been working to the highest degree, to the highest percent recently. But that doesn't mean over the next 5 to 10 years that that's going to be the way it plays itself out. And so that's why discipline is key, and why we love the Dave Ramsey approach, because it gives you a predetermined, preset way to invest. And it's not to say you only pick 4 investments. But it's to say very generally at a high level, that's the way your investment portfolio should look. And then when you keep rebalancing that, guess what you end up doing? You end up doing what our good friend, 95-year-old Mr. Warren Buffett tells us, which is buy low, sell high. Because those people that kept that 25% allocation, it would have meant they would have sold some of those S&P 500 investments at the end of last year. They would have bought into some international investments this year. And you know what that meant? is you made 20 last year on those dollars, and whatever you rebalanced away, you made 20 again this year so far. And that's, my friend, a really strong compound, a really strong, beautiful version of the eighth wonder of the world, compound interest. So yes, we love diversification, Summit. We love when something that wasn't doing well starts to do well, and how that always changes. That's good for investors because it keeps them with a good strategy.
I love how you highlighted rebalancing strategies with that as well, right? As we continue to see some of these sectors or we see some of these indices outweigh the others, we have an opportunity to continue to benefit our clients with rebalancing procedures. So taking a look at that, we look at this holistically. Let's take a look and dive into it a little bit deeper. So specifically, let's take a look at some of the sectors and their performance over the last quarter. What we've seen in the last quarter is kind of interesting to take a look at. So Bitcoin, I've identified here as its own sector because I think it's important to highlight that. And we'll jump into that very shortly. But we're also seeing the communication sector outperform. We're seeing industrials outperform, and some of the big laggards we're seeing, at least for this quarter, and I'll show you very soon what's happened over the last 12 months as well, is energy, the energy sector, healthcare sector, consumer staples, and real estate. Real estate actually does a little bit better when we look at it over a 12-year or 12-month period, but consumer staples in these three also continue to lag. So let's take a look at that also from the last 12 months. So taking a look at this for the last 12 months, I think it's kind of shocking to see this purple line go way up here, and honestly, it's so far off that the rest of the graph had to get kind of smushed there. But Bitcoin has outperformed significantly, 73%, almost 74%. But let's take a look at the rest of the sectors that we traditionally watch. So the communications services sector has definitely done really well. Now remember, the communications sector includes a lot of names like Google, Meta, Spotify, and even has entertainment names like Walt Disney and Netflix. So all of these names are very, very big names that have done very well and are certainly even a part of the Mag 7. Some of them are. The financial sector has continued to outperform and do very well as well. Consumer discretionary, as I mentioned previously. But we're seeing energy and healthcare also lag a little bit. Now, John Mark, I saw this jump off the screen, and you and I have had lots of conversations around this. Certainly our internal research and our external research partners are very keen in watching what's happening with Bitcoin. So how about we take a minute or so and talk a little bit about Bitcoin. So Bitcoin over the last 10 years, and I think this number is shocking, but it's something that we should really highlight. And we'll go into a little bit of detail with this as well. But the Bitcoin price has changed by 41,500% over the last 10 years, less than 10 years, since before 2016, I believe. I believe it launched at about $500 per coin, and now it's selling at over $100,000 per coin. Isn't that incredible? So I know we've been able to, we've read a lot of things, and we're certainly tracking some research around Bitcoin. So we put together this slide that I thought was interesting. John Mark, do you want to take a couple minutes and introduce our viewers about this slide and the data shown here?
Yeah, Bitcoin it's to your point, Summit, it's a newer asset class. It's one that, pre 2008, you couldn't even have considered it. And today, it's maybe making an argument to become the next generation's version of digital gold. And so when you think about an asset class like that is becoming so popular, so mainstream, there's now a corporate balance sheet adoption and massive retail adoption. The likes of Schwab, Fidelity, all have a platform for Bitcoin now with the ETFs that were all produced. What we want to look at is can we garner data that can help us understand, does Bitcoin give us any indications about the stock market? Now, Bitcoin is a risk-on asset, Summit. When you looked at those charts, 41,000% is, or was it 47,000? That's an amazing return. Had you and I done that, we wouldn't be doing this call today. We'd be on the beach retired there, but we didn't. And so here we are. But it is a risk-on asset because there have been some very big moves to the upside, but there have conversely been some very big moves to the downside. And so one of the things our research firm, FS Insights, has helped us with is now it's not statistically something you can lean on at this point because it's not happened enough. But one of the things that they've highlighted is with it being a risk on asset, what we've started to see is as Bitcoin has made new highs, the stock market has been about a month behind that in new highs. And what we mean by that is if you go look on the chart here, you can see in January of 2025, this year, Bitcoin hit an all-time new high in January of 2025. About 1 month later, that was right around January 20th, on February 20th, the S&P 500 also reached a new all-time high. Now, is that the end of the story? Well, as you can see on the more right version of this graph, in May of this year, Bitcoin again, May 22nd to be exact, that it also made another all-time high. And then what happened Thursday of last week, we touched it intraday, and Friday we closed. And today again, we closed at a new record all-time high. Again, roughly about a month later after Bitcoin made an all-time high. So this pattern suggests that Bitcoin has been functioning as a risk-on signal for the stock market. This is, it reflects the investor appetite for growth and for more speculative assets, which is a good thing for stock market. And again, our research partners that we lean on pretty heavily at FS Insights, they've been advising to watch Bitcoin closely as a short-term leading indicator for stock market momentum. Now, again, this isn't something that you could say you could use over the last 10 or 20 years because Bitcoin has not been as mainstream as it is today. So is it statistically important? We don't know. But it is absolutely something we should watch as a leading indicator for the stock market because as Bitcoin breaks to new highs, it might foreshadow improving sentiment, liquidity that spills over into the broader stock markets. And it's not a perfect predictor, but it can be an early stage signal of risk appetite returning to the stock market. And so we've been watching that. And again, that's what you're seeing on your screen.
John Mark, I had a conversation earlier with one of our associates, and him being much younger than me, I asked him around Bitcoin and his thoughts, and he was pretty excited about it because in my mind, Bitcoin's new. I don't really feel comfortable with it. I'm not 100% there yet, but all of his friends and people that he interacts with are all really excited about this. So this is something we definitely need to pay a lot of close attention to as these new investors are coming into the market, retail investors and all of these that are these new investors that are coming in. Now, we've spent a lot of time talking about macro indicators and certainly talking about the equity market. I think it's also important for us to take a couple minutes to highlight what's happening on the fixed income side of it all as well. So a couple things that I want to highlight here is number one, so those of you that follow the fixed income market and look at yield curves, the 2-year yield or the yield curve remains partially inverted still, where we're seeing the 2-year yield still being around 3.9%, which is below the 10-year yield of 4.38%, far below the 20-year or 30-year yield, which is around 4.9%. I think what's important here to highlight for investors is that short-term instruments are still playing high yields for cash management. So you have a lot of great opportunity within your fixed income sleeve or investments, specifically looking at short-term treasuries because interest rates are still pretty high right now. You're seeing the difference between the short-term and the long-term only being about 70 basis points. So there's certainly better opportunity here. Now if you're investing with us here at Whitaker-Myers, we give you exposure to all different kinds of duration, which means the amount of time that you're invested in each one of these particular bonds. So there's still, we make sure that you have exposure to all of that. Once again, focusing back on our diversification conversation. So I think this is really important to highlight here, but we've talked a lot in this conversation, John Mark, around why investors should be optimistic, all the good things that we believe that are potentially happening in the market. So we summed it up in one quick slide, and I'm going to hand it back over to John Mark to talk through these key points.
Yeah, so when you think about your investment portfolio, should I be happy about what we think is going to happen? Or am I going to be unhappy with the second half? We'd say probably today you're pretty happy with the first half of this year. There was a point April 8th and 9th that you were pretty unhappy. We probably, as your financial advisors, would not have gotten an invite to Thanksgiving dinner had things stayed at that level. But they improved. So what are our thoughts on the second half of this year? Well, we are very optimistic about the second half of this year. And why we're optimistic, let's go through 5 quick reasons on why we're optimistic. The investment outlook has improved. When you think about where we were in January, or even where we were in February, because January, the market had a pretty good month in the month of January. We were all positive on all indicators in January, growth and income across growth international. By the end of February, we were positive on international, but negative on the growth and income and aggressive growth there. When you think about the market backdrop today as it relates to either January or February, whatever you want to look at earlier this year, it's significantly better today. And we think conditions are right for a new bull market cycle. Part of the reason is, point number 2, which is policy visibility has increased significantly, meaning we have a lot better visibility on what's going to happen with tariffs. Now we have no clarity, but we have better visibility. We have no clarity. We can tell that because what happened on Friday? Well, on Friday, Trump turned off trade negotiations with Canada. Now, on Sunday night, Canada said, we relent. We're coming back to the table. We'll take that tax off there. So there's still some uncertainty, but we have much better visibility on tariff policy. We have much better visibility on tax policy. We're hopefully, by the end of this week, going to have a new tax policy in place that we can start planning around, unlike the last time we got new tax policy in 2017 that came in December and we had no time to plan around it. This year, we're going to have a lot more time to plan around it, and we have a lot better visibility on the deregulation plan that's going through, specifically in the energy space. And this is reducing uncertainty that held investors back earlier this year. And it, of course, allows companies and markets to plan with more confidence in policy direction. We think that corporate resilience was amazing. If you could say one thing that surprised everyone is in the second quarter earnings, companies did not, on the aggregate, pull their guidance. They continued to give guidance on what they thought was going to happen in the future, and it was good. Companies survived a major stress test in quarter 2 through the tariff wave. And that demonstrates that balance sheets are strong, fundamentals are strong, adaptability is strong, and future earnings growth should be positive. And of course, we have a more dovish Federal Reserve. When you look at the CME Group's chart on where they think interest rates are going to go for the rest of this year, they're currently at this point predicting 3 rate cuts at the second half of this year. By the way, no rate cut at the next policy meeting is their baseline assumption right now. So we don't think we're going to get a rate cut in July, but we do think we're going to get a rate cuts. 3 of them at this point is what the CME Group is predicting. And they're a little more optimistic on rate cuts because several Fed members are advocating for easier policy. They've been on TV last week positioning themselves that they think that we should start cutting rates now. Stop looking at, trying to think about the future and look at current data. They said they were data dependent, and now they're looking at future data. Which is it? You're going to be data dependent? You're going to be future data. And so there's a couple Fed, folks that are asking to say, I think we should cut rates now. And maybe they're advocating for themselves for the next Fed chair nomination from President Trump, because we know he's going to announce a new Fed chair. But maybe they truly believe that we should have an easier rate policy there. And that, of course, supports growth and asset prices. Is essentially we would get a Fed put on the second half of the year on top of the Trump put that's already in place. And then sentiment remains cautious. You say sentiment remains cautious. So people are kind of still pessimistic. Why is that bullish there? Well, when you think about pretty much most non-US investors, international investors, they remain pretty bearish. Partly due to Trump derangement syndrome, which blinds them to the improving fundamentals that we're seeing. We know that institutional investors are still net short, according to positioning data we talked about earlier, and high net worth investors are still bearish because the AAII sentiment report shows persistent negativity across them, and high net worth investors for the last 2 weeks recently haven't increased their cash withholding. So that's a kind of bearish sentiment right there. Retail investors, you could make the argument, are the only group that are expressing optimism right now. And that means that any pullbacks that the market sees will likely be pretty shallow there, as the broad investor base is pretty underexposed. So there's a lot of cash to put into the market to really limit the downside on the market. And we can see that backdrop as setting up for a powerful upside rally, maybe even another face ripper rally like we saw after the tariffs, and as that sideline capital comes back into the markets. So the key takeaway for you is that we are in the early innings of another new bull market cycle. I could spend all day here, Summit, talking about how AI is going to totally upend productivity in the United States. And when productivity, by the way, we're already better in productivity. The U.S. worker is much more productive than Europe, who has basically been flat on their productivity, much more productive than the Chinese worker that has not been as productive there. And AI is only going to further improve that. Now, it might require college age kids to really think about what course they go to for their college degree, because AI might upend some industries, but we're very optimistic. We think, again, early innings of a new bull market cycle, and we would not be alone on that. Folks like Tom Lee, folks like Dan Ives, folks like Brian Belsky, some of the big names on Wall Street that are usually right, that are usually the people you want to listen to. They're right along with us.
It's always great to end on a great note. But with that, I'm going to actually move over to our Q&A section. We've got one question that was submitted, John Mark. I'm going to actually send this over to you. But we have someone who submitted a question that says, "Thank you for your insights today." His question is mostly around our guidance or anything that we can provide in terms of feedback here, really specifically around for those that are accumulators right now, those that are still putting money into their 401k. Do you recommend, or should we, actually, I know we're not allowed to provide recommendations here, but is there anything you can share to this person who asked the question around changing their allocation strategies or staying aligned with the current outlook?
Yeah, it's probably a great question as it relates to the general thing you need to consider with your 401k is, where am I at in that accumulation versus decumulation phase? Meaning, if I'm close enough to decumulation, maybe I need to have some of the investments hedged. Our most popular article we ever wrote, Summit, was called "Bear Markets Normal But Not Fun." And what we looked at in that article was, when you go into a bear market, which is a negative 20 or more on the stock market, the common phrase we get when we're in there, this is common, what people say to me is, "John Mark, I'm retired. I don't have time to let it recover. So thus I should not be in stocks," correct? And the answer is, well, that's a fatalistic way of thinking. That's not correct. If you have a bad health diagnosis, then maybe that is truth to you, but more than likely it's not, because the average bear market takes 330 days, to hit the bottom. Meaning it takes 338 days when you're in a bad market, when you're in probably a recession, to hit the bottom of the market, and then it takes 603 days to get back to where you were, 1.7 years. Now, there's been cycles that have been a lot longer than that. 2008 was a longer drive down and a much longer case to come back up, but it wasn't outside the peripheral of a normal retirement. It was still like a little over a year down and 4 years back up, and better investments would have got you back there a little bit quicker. So where are you at in that accumulation versus decumulation? Because if you're close to that decumulation stage, maybe I should have some safer investments in my 401k to hedge that. If I'm in the accumulation phase still, then generally we'd say you want to be in that growth and income, aggressive growth international. But what you might not have, if anybody is listening on the TSP, that's in the TSP right now, I almost guarantee you that you don't have the I and the S fund, the international and the small company. Why? Because you're looking at the 10-year returns and you're saying those are less than the C fund, less than the S&P 500. And we'd say past performance is not indicative of future returns. Look at the I fund this year. It's up over 20%. You missed it. You really screwed the pooch there, unfortunately, for 2025. So you need to make sure that your 401k portfolio is broken into those four categories. Well, that's the perfect news about that. That's part of the job of your financial advisor. Let them know what investment options you have. They'll break them into those four categories and help make sure that you have allocated across those four categories. And then another thing to watch is there's a couple mutual fund companies out there that are tricky. And what I mean by that is they have international funds that half of the money's in the U.S. stock market. Well, that's not fair. They're only doing that to make you, as a as an investment person that is not in this every day, so you're not necessarily keen on this kind of stuff, think, oh, this international fund's so much better, and you've just doubled your exposure to the U.S. stock market. Not what you want to do with diversification. So you got to make sure you have a pure international fund when you make those investments. There's a company that I could name their name right now. I probably won't because it'll show up on YouTube and I'll get in a lot of trouble from our compliance people and be fined and penalized. So I'll keep their name out of this. But there's a mutual fund company that makes me very upset because their international funds are not international funds. They're cheating to get people to think that they're better international funds. It's Microsoft and Amazon. You're just doubling up on what you already have in your growth fund there. So you need to make sure that that's the case. Again, that's what a good financial advisor. So great question. Make sure you're set up correctly for the accumulation versus decumulation, and make sure that you've got the 4 categories. Make sure you're not underweighted in those categories that haven't looked as good over the last 10 years, but there's probably a pretty strong case that they will be pretty good over the next 10.
And John Mark, we're very close to time. So I'm going to ask our team to take account for all the questions that were submitted. We'll make sure to reach out to all of those that submitted questions and reach out to you after the webinar. Now, to wrap this up, the first half of 2025 has been marked by getting back to some stabilization, not true euphoria. We're seeing the early stages of a broader equity participation, which is very interesting, and certainly we're watching this very closely as we're watching what the Fed is doing very carefully. So risks certainly remain, but so do opportunities, especially in quality assets, and that's why we continue to do our research and we watch all these trends for you. So on behalf of Whitaker-Myers Wealth Managers team, we're grateful that you joined our webinar. And those of you watching this on YouTube, please make sure to hit that like and subscribe button below and to get updates from our team on a variety of topics that we continue to release. So all of this is focused on you and your journey to financial freedom. So with that, I hope you all have a wonderful day, and thank you once again for joining.